Okay, hello everyone. I'm Nick Keeley, a partner in Husch Blackwell's healthcare group. And before we begin, I'd like to cover a few housekeeping items. At the bottom of your audience console, there are multiple application items for your use during the program today. If you have any questions during the webcast, please submit those via the question box. We'll try to answer all questions during the webcast today, but if a fuller answer is needed or we run out of time, we'll answer it later by email. A PDF of the presentation is available in the program materials folder, and auto-generated closed captions are available for today's program. To turn those on, click the CC button in the bottom right corner of the media player box. We'll have a recording of the webcast emailed to you tomorrow for watching and sharing. And toward the end of the program, please be sure to complete our short survey. We really do use your feedback to plan future programs that are applicable to your business needs. That is all for the housekeeping items. Let's get started with our programming. And a big thank you to everyone for joining us for the final program in our Physician Transaction Series, which is an informative three-part webinar series on important topics related to physician practice sales. Today's program will provide an overview of succession planning for physicians considering a transaction or sale of their practice. And joining me today, I am pleased to welcome Brad Gadomski and Scott Casper. Brad is a Vice President and Financial Advisor in the Denver office of Bernstein Private Wealth Management. For over 14 years, Brad has been responsible for guiding individuals, families, foundations, and endowments in making investment decisions to help them achieve their goals. Brad often works in concert with clients' other professional advisors to address critical planning issues such as strategic asset allocation, wealth transfer, philanthropy, and business sales. Before joining Bernstein, Brad served as a vice president at Charles Schwab in downtown Chicago, and he is an accredited asset management specialist and an accredited wealth management advisor. Brad also supports many nonprofit organizations through the local Denver community, most notably serving on the board of the T.C. Chalimi Foundation. I hope I pronounced that right, Brad. Scott Casper is a director at 8 Quarter Advisors. Scott brings an extensive background in corporate development and M&A deal making to the EQA team. And prior to joining 8 Quarter, Scott led numerous deal teams for various public and private companies, driving and completing accretive acquisitions and fortifying long-term business strategies. Most recently, Scott was managing director at Merger Partners, a regional lower middle market investment bank, where he completed numerous transactions over a broad range of industries. He got his bachelor's degree in finance from the University of Texas, go Longhorns, and got an MBA from the University of Denver, go Pioneers. So I am very happy to turn it over to Brad and Scott for today's presentation. Take it away.
All right, well, again, my name is Brad Gadomski, and thank you everybody for attending our session today. We've got a packed agenda. As far as an agenda goes, Scott and I will be going over an overview of succession planning considerations. Scott will talk about that big picture as it relates to the company and what the M&A environment looks like as a whole. We'll do a deeper dive into medical practice sales that we've seen and go through 2 case studies as they relate to an individual partner's balance sheet rather than the company like Scott is used to evaluating. And then we can talk about some financial strategies for succession planning, as you seek to be as efficient and and defer as many taxes as possible as you continue your journey as a partner of a physician group. The first question that I most often get from physicians when we're talking about succession planning and planning for the future, whether that's to operate the business for the long term or to consider a sale going forward, is why to create a succession plan. And a succession plan is important regardless of business phase. It can be for a variety of circumstances, but when the time comes to execute one, it can be unexpected or perhaps it is expected. But when we think about what those exits look like, the more formalized of a succession plan that you have, typically the better outcome that you have. And that's with respect to either operating the practice or considering for sale and getting a value on the business going forward. The other thing I'll mention is that owners and leaders have individual considerations about timing, requirements, and goals in others. So when you create a succession plan, whether it's planned or unplanned, it's important to have a formalized process so that everyone's thoughts are taken into consideration as far as ownership goes. And a formalized plan over the long term can also increase the value of the business and minimize disruption to EBITDA, particularly if it's unexpected. When I think about how to craft a succession plan going forward, a succession plan is really the bedrock to maximize value and efficiency of the practice over time. And typically it'll start with a 5-year business plan that accounts for the ages of the partners and the specialized knowledge that they have. And a buy-sell agreement can also help inform decision-making of owners as they determine what a formal process might look like for how asset values flow from either a sale or from compensation onto their own personal balance sheet, and what that might look like. Finally, as practices evaluate what the successor options look like going forward, typically it's some mix between existing ownership and partners, and I'll hand it over to Scott in a moment to talk about this, but to explore what it might be like to bring a third party into the picture to try to maximize value going forward. While other types of businesses, like non-medical businesses, somehow have family members come in to be part of that succession, we find that to be more and more rare with the specialized knowledge that's required with operating a practice going forward. Scott, I will hand it to you to talk about selling to a third party.
Appreciate it, Brad. Hi, everyone. Welcome today. Appreciate you having me on. I'm a director with 8 Quarter Advisors. We're a lower middle market investment bank based in Denver and Boston. And yeah, happy to get into this today. We'll keep it fairly high level, but really, my focus is on what does it look like to sell your practice? Who are the buyers? What are they looking at? What do deals look like? More kind of the meat of the transaction and things you can do to prepare, what to know in terms of how they're looking at you, and then how to assess the deal landscape and what it looks like to navigate that process. So some of the key considerations here that we like to always talk to physicians about are, what are they considering when deciding to purchase your practice? What are they looking at? And, first and foremost, certainly financials are important. Revenue and EBITDA, the profit that the practice is generating or the multiple practices, certainly comes down to the underwriting risk that the buyer is taking, the growth potential, and the business health. So naturally, financials are super important there. Second thing, the key thing they look at is the billings, the margin, and the upside on some of those procedures. So in terms of physicians, what are the billings and procedures that you guys are doing for your patients? What's the margin on those? And what sort of makes up the cohort of patients that are coming in for those procedures? And is there billing and margin upside to create either, bring more volume in for those patients to do more of those procedures, or to do different ancillary procedures that have, higher upside and higher margins? Certainly, doctors are obviously working to deliver the best service and treatment that they can, as well as looking at the procedures they're doing. But from a financial perspective, this is, another aspect that buyers are going to be looking at. And then thirdly, physicians and staff, super critical. From an physician owner perspective, how replicatable are you? How many of you and or other providers are on your staff that build in that redundancy of service, and also that the book of business, the book of service that the clients that each physician or each provider is seeing makes up the critical mass of business that practice has. And that's a very important thing to buyers when they're looking at, well, okay, Mr. Physician Owner, we're acquiring your practice, but we're looking to extricate you from the business. They want to understand what that looks like when you either move up to a senior advisory role or fully, exited from the business. What's left over in terms of the physicians and providers driving it forward. A couple other key topics are, unsolicited offers versus running a process. We'll kind of talk about what, the differences there, how, we're certainly at EQA partial to running a process. We'll talk about why. LOI and due diligence can get into high level what that looks like, what the process entails and what to expect. Succession and transition, always key things to talk about. And then finally, tax, legal, and wealth management will kind of lead back into what Brad's going to get into. But, thinking about, unsolicited offers versus running a process. This is, we like to say there's no such thing as a free lunch. And so if fielding an unsolicited offer for your practice, there's things to consider where, it might look like the best offer, but that's because it's the only offer. And one thing we say is that running a process it seems like the quick, easy way out and the quick cash, but it naturally comes with caveats, and it doesn't give you that assurance that you've gotten the best offer in the marketplace because it's only the only buyer. And so what we do is focus on running a process, creating a market and competition for the business, which generally brings out the best offers in terms of the best structure, valuation, and also holds that buyer to a certain level of accountability when you do eventually get under LOI and you have to provide that exclusivity to that buyer to move forward and due diligence and look at acquiring your firm. If you've run a marketing process as opposed to just taking the first unsolicited offer that you've received, that buyer has there's some accountability, and you can hold their feet to the fire somewhat, where if this falls apart, if this negotiation doesn't move forward and ends up in a consummation of a transaction, well, because we ran a marketing process, we've got other buyers we can go to. And so those are some of the key things that we like to talk about in terms of the dynamic here between getting an unsolicited offer and running a process. Multiple different buyer pools who we're going to, creating that competitive auction atmosphere, and then, as I mentioned, valuation, sure, and accountability and diligence. Moving into that LOI and diligence period, that's an arduous period. There's no way of getting around it. It's a tough process. In terms of all the data you're going to have to produce, the buyer is going to be looking at your business in more critical ways than you likely ever have. And it's not from they're trying to find things wrong with it, but more of they're assessing their risk and trying to understand what they're buying fully and making sure that everything they think about the business is valid and is what they hope it to be. You're negotiating the exclusive rights to buy that company. So naturally, it's not going to be an easy process. That can take upwards of 3 and 4 months, but we like to just coach our owners and our physician owners on, hey, we're going to be by your side every day you're working on this, help you collecting the data, putting in a repository or a data room so that the buyers can access it. We're there side by side with you, but just understanding that, that process can be challenging. Succession and transition, I'll just touch on this briefly. Obviously important to have, your management team and who identified future leaders. What does that team look like? How does it need to be augmented? Oftentimes buyers are coming in providing sort of the professionalization and the business administration aspect, whereas physician owners, you're the ones responsible for building that team and having those physicians and that other staff of providers around you to make sure that the business continues to drive forward. You're serving patients, your level of service ultimately is continually trending up, and that quality is there. And so it's important to not only your buyers, but the continuation of the firm to have that succession and transition in place. And then lastly, we talk about tax, legal, and wealth management. Certainly it's about building a team of advisors around you. Certainly myself as the investment banker, we're one piece of it. We like to think that during the transaction process, we try to occupy kind of the center of that piece where we pull in those that are needed at different times between tax, legal, and then eventually, you transact. There's a windfall of cash and handing it over to a guy like Brad to help you manage it and build that for your family, for your legacy, and to grow it going forward. And so it's really the concept of that team of advisors around you that we help you put together to affect this transaction. Questions that practice owners often have. There can be many. These are just a few of the more popular ones. How are deals structured? Who are the buyers? What should you do if you receive an offer? We've kind of touched on that. How do you increase the value of your practice? And how do you build and protect wealth beyond the practice? I think kind of diving into some of these, deals can be structured a lot of different ways, but typically there's a cash at closing element. Can be upwards of 70 or 80% of the transaction, obviously also depending on how much of the equity of your practice are you selling. And oftentimes, we encourage, and both buyers are looking for physician owners to what's called rolled equity. And you see that third bullet down there. And that's what that is contributing your, instead of selling 100% of your business, you're selling 60, 70, 80% of it with that remaining 20% that you own rolled into the next entity to ideally have a second liquidity event 3 to 5 years down the road after you've grown the practice with this new institutional buyer partner or strategic partner, and affect another transaction for yourself that you're partaking on. Earnouts can be a common piece of structure as well, really depending on kind of where the operations of the clinics are today. If there's contingent payment on the transaction that needs to be earned by the business hitting certain levels of revenue and EBITDA down the road, that's what manifests as an earnout. It's it goes back and forth. It can depend on market dynamics and practice dynamics, and also certain specialties. It's certainly something. An earnout is, because it's a contingent transaction, there's upside related to it, but it does require hurdles to be hit in order to achieve it. And so us as investment bankers, negotiating and putting your deal together, we always make sure that you're very clear and understand that ultimately the decision to go forward with a deal is yours 100%, but making sure that you're comfortable with the deal that has an earnout component. On that closing day, are you comfortable with what you're getting because of the contingent nature of that earnout, and making sure that on day one you're already satisfied with the deal you've got. And then employment agreements, non-compete agreements, these are pretty common, especially on the physician side, ensuring that you're going to be part of the practice. As we mentioned, how important to the practice, the book of clients that you have, are you? And so making sure that your hitch to the practice for a certain number of years can be really important. Looks like there's a question here. Ed Barker's asking, the buyer's trying to flip in 3 to 5 years. That's often the case with like private equity or institutional capital buyers. They are, as financial buyers, looking to oftentimes sell the practice again after growing it, adding physicians, adding locations in a 3 to 5 year time period. But you, as the physician, if you've like I say, rolled equity into that transaction, you can participate in that upside. And one of the key things we like to talk about is, in taking on this partnership with this institutional backing, you're now growing the firm, but not at your own risk. You've taken chips off the table, you've de-risked, and that's an important thing for your own personal situation. But then you're getting to partake in the upside that is getting funded by an institutional partner. So it's somewhat of a win-win there. Getting into how to increase the value of your practice. Yeah, certainly focus on revenue and EBITDA. What drives your business? What does your referral base look like? Where are your clients coming from? Where are your patients coming from? Are there other physicians, other networks that you've tapped into to have that referral base? That becomes a very important consideration for buyers that they're looking at, is where are your patients coming from? Are they likely to continue coming? And how do we grow those referral sources to ultimately grow the practice? There's always a lot of talk about EBITDA multiples and how do I get 8 or 10x on my EBITDA, and the number you'd like to get, or the number that you heard from the country club anecdotally. Generally, larger EBITDA does mean larger multiples on valuation, but there are lots of different aspects and things that go into that, how that multiple gets calculated. Generally, it is fair to say a larger EBITDA will garner a larger multiple, but growth prospects are super important. Physicians and staff is super important, and oftentimes the specialty too. I have there, relative to specialty groups. So does an orthopedic group garner a higher multiple than a physical therapy group, or are there even synergies between them? Yes, that can happen, but it does tend to be a case by case basis. Another thing to look at is billings and procedures. Certainly, we've touched on this: higher margins, the volume by procedure, and the patient mix. What are there cohorts of patients coming in doing certain procedures that are higher margin, or is your volume made up on quicker inpatient, lower margin but higher volume procedures that are driving it? What's the revenue and patient mix that are driving those billings and procedures? That's a key consideration. And if you could look at it from a critical eye of saying, well, these patients are getting these procedures that are higher margin and higher mix, I should drive those, and certainly want to keep the lights on with the lower margin, but you got to balance out what you're serving while ultimately still providing that great service that your practice has. Physicians and staff, we've mentioned, staff with high morale, low turnover, stability of those physicians continuing to grow. Certainly the culture is important within the offices as well. Our doctors and providers and nurses and the whole team rowing together to produce that experience. It's not just the experience that they're getting, that your patients are getting with you, the physician. It's everyone they're interacting at the clinic. And then lastly, risk management is super important. Obviously, record keeping, compliance, liability management, and making sure you're checking all the boxes that you need that your practice needs to keep the licenses that it has and keep the lights on and certainly operating. Real estate transactions, this is often a part of businesses we sell and physician practices, and whether they're owned or leased plays into it. We typically are involving commercial real estate players to come opine on what the real estate piece of a transaction look like. Certainly, sale leasebacks can be welcomed and are a key thing that can happen. We're more focused on what's going on in the transaction. What does the business look like? What's it doing? Where is it going? And how does that equate to a deal? But the real estate piece is always an important consideration, whether the physician owns the location or is leasing, and what's the best way for the business to grow, whether that's through more leases or more owning or purchasing of new locations. What to do if you receive an offer. Certainly from a self-serving perspective, we think you should, talk to, an investment banker or other, an attorney, other financial advisors to kind of get a smell test on what does this offer look like. It gets back to that unsolicited offer versus running a market process. We feel it's always better to run a market process because that you've tapped the market, you've gone out, you've run a process, and you're getting the best possible offer. But so, if you are considering an unsolicited offer, surround yourself with a team. Get as much free advice as you can. Certainly involve that team to advise you and opine on what you're looking at. And the choice is always going to be yours of how to move forward. But certainly involving a team around you when you get an offer is a good first step to take. Considering the culture is super important as well. As I mentioned, the physicians and staff. That cultural piece is critically important, especially for a physician staff, because as I mentioned, not only are our patients interacting with doctors, but they're interacting with everyone on staff. And that's going to affect, certainly how you're viewed in the marketplace. And in today's digital age, reviews and things online are a very critical part of how people are looking at whether going to see, your type of doctor. There's lots of different, or there's many different specialties, of which there are many different options for the specialty that you need. And so those reviews, end up counting a lot. Looking at the financial, does the deal provide enough financially? This kind of gets into Brad's space of looking at how to put a plan together and make sure you're taken care of comfortably at the level that you'd like. And does the deal provide enough for what I'm looking for? And does my business garner, from a valuation perspective, what I'm looking for? Do I need to go grow it using the concepts and avenues I described earlier? And then lastly, we talk about this here internally at EQA. There is no such thing as a free lunch, as much as we want to believe and think that it seems too good to be true. Often it is. If you've got buyers saying, hey, I'm going to pay you $10 million cash, and I've just got a few questions on diligence, and it's only going to take a couple months, it's just never that way. And not to say that there's not, a unicorn here every now and then, but there really is no such thing as a free lunch in terms of someone buying your practice, because it's a complicated, complex transaction, and no buyer has the ability to write a check like that is going to just do so without a pretty arduous process. And as I mentioned, if they've got into you early, and you've granted some exclusivity by signing an LOI without running that marketing process, well, then you're at their disposal, and they're under no pressure or accountability to move forward and get through their diligence and close that transaction when they know they're the only buyer at the table. That leaves you without leverage in that position, and that's just a position we don't like our clients to be in. So I'll kind of toss it back to Brad to kind of get into his case studies, but as questions come up, happy to get into anything else that comes up.
Thank you, Scott. Really appreciate it. And, what I think it's important, as Scott and I have worked with different entrepreneurs and different partners as they consider selling their practice, really what it comes down to in that decision to sell and to move forward is, are my objectives met? And as an individual partner or an individual physician, if we're going to execute on a particular transaction, do I have confidence that I can live life the way that I want to, And do I have confidence that I can dimension the risk of this deal and know that, for example, if I'm going to take reduced compensation for a number of years, but there's the idea of a particular earnout over time, can I dimension what that risk looks like? And can I dimension how that's going to affect my personal balance sheet? So that when I go into a transaction, if we're ultimately going to execute on it, we're in with both eyes open and understand the implications of what that might look like for an individual physician. The first step in determining how a particular deal might affect an individual physician's balance sheet is to consider their own personal situation and determine what their life looks like from a core and from a surplus capital perspective. A couple things to keep in mind. We at the firm refer to core capital as capital that you actually need. That's capital to pay your bills, to live life the way you want to carry on and live the life that you're looking for. And then after determining what core capital looks like, adjusting that for lifestyle spending, adjusting that for inflation, taking other factors into consideration on what a potential earnout might look like, how that could affect, what happens if a rollout ends up being 0 value rather than 3x value. These are all the things that we want to get down and break down into core capital so that we can determine, particularly after a number of years, what is surplus capital? Because surplus capital is essentially everything else. And for physicians that have studied hard through medical school and have high earnings throughout their career, oftentimes they find themselves in a position where there is surplus capital, where they essentially have more than they need, and they need to start thinking about, what do I do with that capital? How can I be most efficient besides give it to the government, after I pass over time? And there's not too many places that your money can go over time. I mean, you could essentially give it away, you could designate it to beneficiaries, or you could give it to the government. And so the idea there is to dimension all of that so that when you're thinking about the critical decision behind should I move forward with a particular transaction or not, that you've dimensioned all of those things and how they might interact with your individual situation. When you consider putting a plan together to determine, is this transaction worth it for me, or should I continue to operate, particularly if I'm operating at a higher income? There's a variety of things that need to go into that process to be able to project those values in an accurate way. And when you undergo a process like this, the outputs are only as good as the inputs. So it's important to run a customized approach, because for most physicians, particularly ones that are entering a transaction, it's a lot more than, do I just have enough money? Because for most of them, they know they have enough money. And the question they're typically asking, rather than do I have enough, is what am I missing? And so as they put together all the inputs of a particular plan, whether it be what your risk tolerance looks like, what your time horizon looks like, if it's a share deal, are you receiving liquid assets? And if they're not liquid assets, do you have the ability to live your life with the existing liquidity? And is there a plan to create a liquidity schedule for those assets? All of those things are going to go into the essentially trying to determine what the trade-offs are of building a particular plan and ensuring that it works for you and your family. I will walk through 2 case studies today to hopefully give you an idea of physicians that we've worked with that were approaching the decision around, should I continue with executing on a deal, or should I continue to operate my practice as is? And for this particular case, it was a 60-year-old pain management doctor, Texas resident, so we did not have to account for state income taxes, but had existing assets of $5 million before any deal. So essentially knew that if he doesn't have enough, he knows that I may have enough, has a really healthy income, and has spending levels of roughly $300,000. His plan originally was to continue to operate the business for 5 more years. And as we've seen so many times, particularly with how hot the M&A market is getting, a private equity group had come forward and given a transaction offer. And what we were tasked with this particular position was determining, from a personal balance sheet standpoint, because they figured it was a good deal for the business, but for what they would end up with as a partner, is it worth it to execute on this deal now, or would it be worth it to continue to operate at a higher income level as is? And what are the decisions that go into making those types of decisions? For evaluating that transaction, it was an aggregate amount of $6 million. $4 million was an upfront cash payment, and then there was a potential for $2 million rolled equity going forward, with the kicker being that there was a severe reduction in compensation over the next few years. So we had to determine, if we put all these factors at play and the physician was going to accept a lot less compensation going forward, how would that affect their personal balance sheet? And how could that dimension if they should go through with the deal or not? There are many inputs that go in when we're working with an individual person on their personal balance sheet on what goes into, should I move forward with this or not? But one of the key metrics for how to determine, do I have enough money or not, and can this deal satisfy my objectives and my needs going forward? Two of those key inputs are the way that you're allocated and what your investment life has looked like, whether you're invested in private equity, whether you're invested in public equities or perhaps real estate, and considering how much money do I have now versus how much money will I need in the future. So what this chart shows is this particular physician starting day one from the process of determining, should I enter into a transaction or not? This physician had accrued roughly $5 million worth of asset value that was on their balance sheet to be able to live life the way they want and retire the way they want. And what this chart shows essentially is the more aggressive that we would assume the type of investing that the physician does going forward, the less they actually need today. Because if they were somebody, let's say on the left, that were planning on staying in cash throughout their entire life, well, to live the way they want to according to their existing expenses, essentially what they need is $13 million. And so what that tells them for somebody that's planning on staying in cash their whole life is, if they have $5 million now, they know that they need 13 to be able to live the life that they want. Essentially what that's saying is they need $8 million out of this deal. So that was a starting point to say, look, there are many different inputs that we can use when we're determining, should we move forward with a particular process or with a particular deal, but dimensioning how much money do I actually need out of this deal for this to make sense for me so that I can live the life the way I want to. This is an important part of calculating that. And what this shows is that for somebody that has more of a balanced portfolio and assumes investing in a balanced portfolio going forward, if we look at the second bar from the right, what this is showing is that they have 5 million now. If we assume a moderate level of growth within the portfolio going forward, really instead of staying in cash, but investing in a balanced way, what we show is out of this deal, we need the difference of 8.7 versus 5. So instead of requiring almost twice the capital out of a deal, what this physician needs is roughly $4 million out of the deal today to be able to live life the way they want to. So there's a variety of different factors that go into all of the different inputs of a plan. And these different inputs, whether they're based on spending, whether they're based on family legacy or risk tolerance, all of these things determine not just what life looks like going forward, but what value you actually need out of a deal as you're evaluating different bids that you receive from a private equity group or from a third party. As we were working with this physician, what we wanted to determine, particularly in the short term, so 5 years out, is can we quantify the difference in keeping the existing higher compensation and operating the practice as is versus taking a deal and then illustrating those trade-offs where if there was an offer that they took, what would that look like based on a series of different assumptions? And what the physician was essentially trying to drill down on was, look, I'm making twice the money now that I would post-transaction, so why would I move forward with it, and what's the math behind that? And so what you see on this chart is, on the first scenario, scenario A, essentially this is somebody that's entirely in cash and is not moving forward with the deal, but is going to continue to operate at that higher income going forward. And so this is essentially impact on personal wealth, excluding that first $5 million that we know that they have, but just evaluating 5 years into this deal, forget my personal balance sheet to begin with, what is the impact of either taking the deal or not taking the deal? Not taking the deal from an increasing compensation standpoint, or taking the deal and operating at a reduced income. And what you find is if this physician were to take the deal going forward, even if they were to stay in cash, they end up with a much larger amount initially, 5 years out, but they also put themselves in a position where you can see the three asset values within this bar chart. What the three asset values show is the median amount of wealth, that middle number being the median amount of wealth that they can expect between a variety of different market factors for the given risk that they're taking. And what they found is that if you go forward to scenario C on the right and scenario D on the right, taking the deal, whether you stayed in cash or whether you decided to invest in a moderately aggressive portfolio, you were well ahead as where you would have otherwise been 5 years before that. The other thing I would mention is that the big determining factor between the two scenarios not taking the deal versus the two scenarios taking the deal is allocation didn't play a big part if they were not to take that deal today. But if they did take that deal and they moved 5 years out and assumed growth, they were able to achieve a higher level of growth because it was a higher level of capital to begin with. So all this to say that depending on what action you take with your business, there's going to be variables that are more sensitive than others. In this case, if they were to execute on the deal, the variable of allocation and how much growth to assume is a key determining factor on what those asset values look like going forward. Another part of this was trying to determine what is the difference in capital that I have over the short term on selling the practice versus not selling the practice. Because if I don't sell the practice, I make roughly twice the income. If I do, I have to essentially take the risk of what rolled equity could look like 5 years down the road, plus reduced earnings. But because of selling the practice to begin with, if you were to sell that on day one, you can enjoy a higher level of growth just on the existing assets. And what you find is that if you don't sell the practice 6 years in, you've accrued a great amount of assets, but it only took you about 1.5 years to accrue those assets if you sold the practice, but you had to make a series of assumptions. First, you had to weather the risk of operating the practice going forward. So the question would be, at your given EBITDA level for the practice, do you think you can continue to maintain that with regulations changing over the next 1 to 6 years? Do you think that the existing business as it operates will continue to enjoy the same amount of margin 6 years out as you are today? So there are assumptions going into that versus if you were to sell the practice, and I'll help to define what this looks like later in this case study. But even if you were to sell the practice and 5 years in, not get rolled equity, you still are ahead. Rolled equity for this particular circumstance, and it's different for every deal that we look at when we're evaluating it from a personal balance sheet. But in this case, rolled equity was one of the most sensitive things to measure for because the factors were so heavy from essentially taking that RE and going 3x. It helps determine what both the top and the bottom side can look like so we can focus on a median value and help a physician determine from my own balance sheet, do I move forward with this deal or do I continue to operate the business as is? Where you really start to see a huge difference is in the range of relationship values. When you look 30 years out to determine, and this person was 60, so we're looking at 90 years old, what is the impact later in life for if I am evaluating my balance sheet and I have goals of things like children's legacy, or I have philanthropic goals, or perhaps they have goals really of any sort and need a defined period of capital. What does that look like? And what you find is that even if they were to sell and not receive any of the rolled equity at all, it still puts them in almost twice the median value as they would have been to begin with. So on the left side, what we assume is a portfolio that's moderate to moderately aggressive, so it's about 65% equities. What does that look like with no sale? So taking $5 million and weathering those increased earnings for a period of time for 5 years, retiring, and then withdrawing capital to live the way you want, and also assuming growth of the portfolio. And it puts them at roughly $10 million or $9.7 million. But importantly, when we look at asset values going forward, the median amount was just under $10 million. If we stress what that looks like, if we look at that very top number, that's the top 10% of scenarios, depending on what market returns look like, they end up with a great number. And I don't want to focus too much on that number, because if we get there, that's essentially gravy. But what's most important is that bottom number. That bottom number, assuming that we have turmoil in the markets for a long period of time, this person could take a look and say, I have potential for running out of money. So there's various things that they could do to try to combat that. But all things equal, if they wanted to say, look, I want to spend $300,000 a year and I don't want to think about it again, there are some very low odds that they could run out of money. Versus if they were to move forward and transact on the deal, not only do they enjoy a higher level of wealth, but they've taken the possibility of running out of money off the table entirely. So for this physician, it was very important to meet that objective, to say, look, I don't just want more money. I have to be able to know that going forward, I have been financially secure in my plan, so that I can start to dimension, even if this rolled equity doesn't work out, that I have taken the most severe of impacts off the table. Beyond that, we were able to dimension what might it look like if you had rolled equity go 2x or go 3x over time. Those numbers continue to get bigger. It opens up a conversation around, what do we do with this capital? Because for somebody that's spending $300,000 a year, now you've moved into an asset base where you have more than enough, plenty more than enough. What is the plan for that surplus capital? And essentially, what does it look like? The second case study I'll go through briefly was a similar experience, but this physician was not worried about, do I have enough money? They knew they had enough, but it was planning for the future. And how do I know that this money won't go to the government? And what are the things I can do both pre and post transaction to ensure that my family, my beneficiaries, my legacy, and my objectives are taken care of over time? There's a variety of different things that you can do, even if it's very late to the table, where you're evaluating a deal, you think you're going to move forward in the next year, you've done no pre-transaction planning at all. There are still a variety of different things that you can do to reduce the liability or reduce the impact of taxes going forward, even after a transaction. I won't go through all of them, but just as an example, there are things you can do where if you've taken a share deal for your practice and you move those shares into different investments within 180 days, very similar to a 1031 that you might do with real estate, you have the ability to shed a lot of those gains and not just defer them, but if you're using the right vehicle, absorb them over time. The most important thing you could do, though, as you continue to consider, how do I plan for a practice sale? The most important thing you can do by far is what you do before the sale. Your menu of weapons that you can use to shield taxable liabilities and shield taxable gains is dramatically more powerful if you do the planning ahead of time versus after. And really what that means is before you receive an LOI, because when the IRS looks at an LOI, what they see is, I see a firm value on that business, and now I know I have a value, versus the IRS does not know what the value looks like beforehand. And so if you can take advantage of that pre-transaction planning ahead of time, and I'll dimension what this looks like from a math perspective, but if you can do these things ahead of time, particularly if you use qualified small business stock, you have the ability to create $10 million tranches, put the private shares of your company within those tranches, and when there's a large capital gain, to be able to shield yourself and your estate from that gain going forward. Those are all things that I'll dimension a portion of so that you can see the math going forward. But these are the things that if you're considering either now or 5 years from now, entering into a transaction, investment returns can only get you so far. What's going to be the meat and potatoes of what's going to drive your asset values is going to be either tax absorption or tax deferment going forward before you enter that transaction. And for some of these strategies, particularly qualified small business, there's a time frame on that the IRS sets. So you want to start as close to 5 years ahead of time as you possibly can. With this particular case, we were working with a doctor who owned her own practice and had 5 partners. She was 60 years of age and considering retirement, knew she had enough with roughly $10.5 million and wanted to know, can I retire in 5 years? And can I still achieve my objectives going forward? She knew she needed the right investment allocation to achieve this, but that wasn't what was most important. What was most important is her practice had received an offer for $30 million. Her share of that offer was $5 million, roughly 3.75 in cash and the rest in rolled equity. When you're talking to a partner of a practice, no one knows more about that practice and what to expect than the partner does. So we're always willing to stress rolled equity projections as much as we can. But what we were tasked in doing from this position was going through what might be an expected value 5 years from now, 3 times the equity of what to expect. And the key part of this in determining should she move forward or not, essentially there was a huge reduction in compensation. So she was taking a 25% hit for 5 years, so foregoing quite a bit of what that compensation might be. And we were tasked with determining, does this make sense or does it not? And what are the things that we need to plan for going forward? So she had $10.5 million. And when we assume just that figure of the growth of the next 35 years and what we could expect, it put her in a position where she had an estate tax problem. So there were many different aspects of what she could rely on and the different levers and pulleys that she could pull to be able to determine how much money of this can I keep and can I meet my objectives on an after-tax basis. But what she found was that when you look at the estate tax exclusion today, it's scheduled to sunset in 2026. It's roughly $13 million a person. So husband and wife together essentially can have $26 million worth of an exclusion. But if she were to take this deal and assume 30 years worth of growth, she's going to be way over that estate tax limit. So how to plan for that going forward was very important, because even if we assume that the estate tax exemption isn't going to change, and we think it is going to change, but even if it doesn't, she's still going to have an estate tax problem. But if it sunsets in 2026 and it goes back to 7 million, so 14 million for a couple, she's going to have a considerable estate tax problem. So what she needed to do was determine if she were to take this deal and have an estate tax problem going forward, when she gives her chunk of money to Uncle Sam, was it worth it on an after-tax basis to be able to take care of her family? There are lots of different weapons that you can use when it comes to wealth transfer to try to get particularly a post-transaction and pre-transaction value off your balance sheet and off your estate burden. So I'm not going to go through the specifics of all of them. I'm happy to do that with any individual circumstance, but there's a lot to be able to use both pre and post-transaction to be able to get these things off of your estate. And the sooner that you do it, the better, because these asset values, particularly when you start talking about $10 million plus, start to grow very, very quickly. And the sooner that you can put those, essentially, particularly if it's a share deal, the sooner you can take those company shares and shield them in an irrevocable trust, the sooner you can enjoy those gains tax-free over time. When we evaluated what this would look like, what you're looking at is 3 scenarios for potential estate tax based on this physician moving forward with taking a deal and fast forwarding 35 years. So essentially putting them to 95 years old. And if she were to simply work the 5 years throughout her practice, she's going to have a great deal of money. She's going to have roughly $30 million worth of money, but that's the result of an estate tax problem because she's dramatically over the estate tax limit. So the day that her and her husband essentially get hit by a bus, the estate owes the IRS $3.2 million. Where she even has a larger problem is if we assume that her rolled equity is going to do very well 5 years from now and is going to have a 3x return. Now she's even further into estate tax territory. Now she's got a total value between real estate, the portfolio, the after-tax business proceeds, and the compensation for 5 years of operating of roughly $37 million. And so the estate, the day that her and her husband get hit by a bus, is giving a check to the IRS for $8 million. There are things, just to mention what trust work can do for you. If you were to do these things ahead of time and establish irrevocable trust to be able to shield these capital gains, her family, just by taking action before and shielding those gains, in this case, it was a share deal, taking the shares of that private business and putting into in this case, a spousal lifetime access trust. What it did is essentially absorb $7 million worth of state tax and add $7 million worth of overall value to their balance sheet. And so from there, they could determine, what do we do with the $7 million, whether it's giving to philanthropy, establishing different trusts, setting up educational accounts for grandkids. It opened up the conversation to not only, what do I do with this extra money and how do I structure it, but also, how do I talk to the next generation in a curated way about the responsibility of these assets and the expectations behind them. The last thing I'll mention is there are many different takeaways from trying to evaluate what are the considerations that you should be putting on the table when you're considering taking a transaction versus not. But I'd say that the biggest takeaways are, you want to ensure that you know the EBITDA of the company and that you keep it constant or increase it over time, and that you have a plan to deal with succession issues if one comes up. The other thing I'll mention, particularly because it's a group of physicians, whether it's law or medical, one of the best things that you can do to save tax efficiently over time. And the reason I bring this up is because when you look at the value of a $1 million portfolio, if you assume higher taxes or you assume higher returns going forward, both of those multiply with one another. And so the more money that you can put away and the earlier you can do it with the higher amount of return going forward, the more you can defer on your taxable burden going forward. And what this is showing is, on the left side, taking a 5% return versus on the right side, taking a 10% return. Putting that money away in a tax-deferred vehicle, saving it over 10 years and investing it, and comparing it to what you would have otherwise had if you just paid taxes on it in a 43% tax bracket. And the higher you assume returns and the higher you assume taxes, the more of the benefit you get from going early, often, and investing aggressively. The best way to do this by far, and there are implications for trying to determine, is a cash balance plan right for your practice or not. But for physicians that have excess capital and want to put it away in a tax-deferred vehicle, typically when they look at their earnings, they've maximized it through 401k and they've maximized it through a profit-sharing approach. But they know that if they could put an additional amount of capital away in a tax-deferred vehicle, that they would. That is where a cash balance plan comes in. Cash balance plans have lots of ins and outs of them in determining, do you qualify? One of the biggest key drivers is how many partners are there versus how many just general employees are there. But what you can find over time is the amount that you put away in a cash balance plan, particularly as you get later in life into your 60s, can be a dramatically more amount than it would have been just putting away money via profit sharing and 401k. So in the interest of time, I am going to be quiet for a moment and pass it back to Nick for closing comments.
Thank you, Brad. You actually made that, notwithstanding that it could be considered somewhat dry, you made that very interesting. So I really appreciate that. Okay, well, I want to thank everybody for joining us today. We hope the information was helpful to you and your organization. Final notes as a reminder, a recording of the webcast will be emailed to you tomorrow for watching and sharing. And please be sure to complete the short survey. We do use your feedback to plan future programs to make sure that they're applicable and useful for your business needs. So please do complete that short survey. That completes the webinar. Thank you to Brad and Scott for presenting today, and have a great rest of your day. Thanks very much.